we'll see a little bit of a status quo messaging and think. This is in stark contrast to where we were just a year ago. A year ago, the Fed was forecasting the fact that they were going to raise rates 3 times. Yes, I said that right, Courtney. They were going to raise rates. And what did we see in 2019? They actually cut rates. So this very accommodative stance by the Federal Reserve will be interesting to see how Jerome Powell sets up and forecasts 2020. But don't forget, Courtney, we also have the ECB this week. We have a lot of central bankers continue to push risk on in the markets, and therefore, I think we see constructiveness. And I know we saw a lot of red on the markets this morning. We're not going to talk about the red of Ohio State and your Buckeyes, but I think the red I want to talk about is in Santa Claus. I think the Santa Claus rally is intact as long as we have something positive out of December 15th trade tariff conversation or deadline.
So Mike Santoli was telling me that the Santa Claus rally really technically is like Christmas to New Year's. That's pretty short. That's much shorter than I thought, no?
It is, and it's remarkable to see because those are typically low volume times, but it's all contingent upon this trade tariff conversation. But that's been front and center all year in 2019. But what's behind the scene? It's the accommodative stance. You look at treasuries, you look at utilities, all the movement into these different sectors has been by and large due to the fact that the rates are staying low. So when you look at the 10-year note at 180, 181 like it is right now, in comparison to the German Bund, which is still minus 30 basis points, I think that 10-year note, it's hard to believe, Courtney, it's 2020 almost, and here we are with the sub 2% 10-year, but that environment is really a risk-on environment.
It's interesting that you say that the Fed is really behind all of this if you think about the timing, because you have the Fed meeting now, and then we have this December 15th deadline a couple days from now. So if you're Chairman Powell, what's your calculus to try to figure out what your message should be to the market when you have this huge uncertainty 4 days out?
Well, that's a great point. I think what he did, and I'll give a little kudos and tip of the hat to Fed Chair Powell, what he did is he got out in front of it. All of 2019, these rate cuts, this was really putting a little bit of cushion on the tarmac. So think about it. If we don't get this December 15th trade tariff deal, actually this phase 1 deal, the market pulls back. If the market goes down 100 handles in the S&P 500, 3%, we're still above the highs that we put in earlier this year. So there's a lot of cushion. There's a big pillow sitting on the tarmac, and Fed Chairman Powell really deliberately did that.
When I think about this December 15th deadline and whether we get these new tariffs or not, to me, I just wonder really, how helpful is it? Because they don't exist now, right? So if we don't get them, did it really help anything or just kept things from getting worse from the market's point of view?
Well, I think you bring up a great point in the fact that the tariff is the focus, but think about what started all the problems here. It was the fact that we really wanted these tariffs to be implemented to change the intellectual property component. That's been the focus of it, even though it's not talked enough about, but we will see how that works out. But I think we started with tariffs, we have to end with tariffs, so I think we have to have something. But what's interesting, Courtney, is the data. The data out of China is showing that we have the stronger hand. We just saw a jobs number. We're in the wake of a great jobs number. We saw our former friend and colleague, well, he's still a friend, our former colleague Larry Kudlow come out and talk about how great the U.S. economy is. So that's in stark contrast to the China situation. So I think we do see something happen, or at least something to nibble on December 15th.
Are you looking at things in China like the customs data that we saw yesterday that showed that maybe we have an upper hand there? I mean,
auto sales overnight. There's a lot of different data points that you can really point to, Courtney, but I think the fact we have to remain focused on the U.S. economy. I work with a lot of financial advisors across the country. Everywhere I go, I am seeing strength in the economy. I'm seeing cranes in the air. So I think we're in a pretty good spot. The data is starting to support that. And the accommodative stance by the Federal Reserve, that is really helping markets heal and move forward.
The job market obviously very strong from that last report, much stronger than I think many of us expected, 266,000 jobs. That pace may not be able to continue. If you look at certain sectors like manufacturing, some noise there with the GM workers that were striking coming back. But what about in general manufacturing? Have we hit a trough? What do you think there in that sector for the U.S.?
I think manufacturing, by and large, in the U.S. has changed dramatically from where it was from a couple decades ago. So we have to get our arms around that. But I think if we look at one of the sectors that we really focus on, in the sector that's still revealing relative strength, it's technology. And I know we talk a lot about technology, but it's been 2 years. And if you look at the FANG stocks, if you take Apple out of the picture and Facebook, maybe there's not as much bite in the FANG, but those FANG stocks are still acquiring assets. They're still attracting investors globally. So the technology sector we like in 2020. I think you have to stick with the themes. I know a lot of people talk about the dog and the Dows. Not so much. I think, next year you're going to continue to see assets and themes that worked in 2019 carry over in 2020.